What's up, everyone? Dylan O'Neill here. I wanted to hop on and do a trade recap video going over the big short setup that I took on the S&P 500 futures on December 13th, which happened to be the day of CPI. As many of you guys know, I planned this short setup well over a month in advance, okay? So I knew exactly where I was going to enter, stop out, and take profits on this trade a little over a month prior to the trade even triggering. Okay, so the original orders were set on November 14th. This trade did not trigger until December 13th. So as you guys could see, in this case, a little less than a month, the orders were sitting there. Okay, considering the December S&P 500 futures contract rolled into March, I canceled the original orders and then put the new orders for the March contract in on December 11th at 6:58 p.m. Okay, so 2 days before it triggered, the limit orders were set. I had 5 different limit orders for entries, and then I had a buy stop order as a stop loss. Okay, so the way I structure my plans are to ensure that I am ready for any outcome. So before the trade even triggers, I am well aware of exactly what to do no matter what the outcome is. And what I mean by that is each one of my setups has a calculated risk involved, okay? So as mentioned numerous times, the lowest risk parameter that I'll use is 2.5 to 1, meaning for every $1 that I'm risking, I'm making $2.5. Okay, so this video is going to be cut in 2 parts. Today, I'm going to talk about why I took the trade. What was the technical reasoning, the fundamental reasoning, and just go over the full thesis behind this trade. The next part, which I'm going to post either Wednesday or Thursday of this week, is going to go over the risk management. I'm going to review exactly how I calculate my risk management, which is even more important. So a lot of you guys will like today's video because it's not going to be as boring as the one I post later on this week. But you have to understand that without risk management, you have nothing. So you could be the best technical analyst in the country, right? You could have the sharpest focus and knowledge when it comes to charts, reading charts, so on and so forth. But if you lack the risk management aspect, you have nothing. I see it all the time in the Discord. Some of you guys have excellent analysis. You come up with great plans. However, you lack the follow through. You lack the the ability to enter into the trade and follow your plan from start to finish. And what that does is it makes your winners smaller than they should be, and it lets your your losers run. So because your risk management is skewed, it makes it very, very difficult to compound gains, over time. So, like I said, get ready for that risk management aspect for this video later on in the week. So, as I said, let's hop right into this video and go over exactly why I took it in regards to fundamental and technical analysis. So, we had 690-minute supply, okay? Why 690 minutes? I get asked that many, many times. It's because for futures, they work very, very well. Dylan, why 690 minutes? Good question. The S&P 500 futures are open for 23 hours Monday to Friday, okay? They are closed for 1 hour in between 5 p.m. Eastern Time and 6 p.m., okay? So the 23 hours that they are open throughout the week, you divide 23 by 2, right? And you get 2 690-minute candles, right? 690-minute is equivalent to 11.5, which is 2 halves of 23 hours. So based on tons of back testing that I did over the last 2-3 years, I noticed that 690-minute zones worked very, very well for futures. They do not have any significance when it comes to stocks. I see a lot of you guys using it for stocks, but just know that it has no technical significance. So it might work here and there by coincidence, but 690-minute works best for futures, okay? So that was the first aspect of this trade, this 690-minute. Also, the 50% Fibonacci retracement from the all-time high to the 52-week lows happen to line up exactly within that zone, okay? So those were two very, very important technicals behind this trade. Okay, I'm going to go ahead and draw a segment at 4155.25. Okay, just to show you guys where the 50% retracement is. Okay. So, right there, that's two different confirmations from a technical analysis viewpoint as to why I believed strong institutional sellers were going to reload at that area. As mentioned, this was a trade setup that I talked about for the last month, okay? So as you can see here on November 28th, I said, I still believe the market has room to the upside where stronger sellers will eventually reload for a deeper pullback. I am still interested in trying a short in the 4150 plus area on ES. So like I said, my original orders were set on November 14th. So 2 weeks after I put my original orders in, I wrote this in my pre-market plan. And I knew exactly where my orders stood. And I knew that my average price was 41.48 and change. It came out to like 41.48.57. So when I typed this, I already knew exactly where I wanted to get in, exactly where my stop loss was, my targets, so on and so forth. So those two details are very, very important technical-wise. Another very important technical context is the fact that the S&P 500 had this massive downtrend resistance line that marked 3 long-term macro tops, okay? So this high in January, and then another high in March, and then another high in August, all hit that same exact downtrend resistance line before plummeting, okay? So one of the things that I told you guys in 3 different weekly analysis videos prior to this trade triggering is the fact that I am looking for a nice rally above this trend line, which will trap bulls, okay? Institutional sellers need the liquidity from the bulls, okay? So I love to trade setups that are traps, right? I love reverse engineering the minds of the retail trader so I can get the advantage going against them. Okay, this is a topic that I made a video about. Okay, on November 2nd, I talked about this same concept of how to find where larger market participants are looking to reload. A lot of what I'm talking about for this particular setup is mentioned in this video. So if you haven't seen it, I recommend it. Okay? So now we have three different reasons. We have the 50% retracement from the all-time highs to the 52-week lows. We have 690-minute supply. And we have a bull trap that many retail traders are looking at. So many of you guys would think, oh, if we break above this downtrend resistance, we're going to see a nice rally towards 43 and a half near this last major macro high pivot point. Okay, so when ES breaks above that trend line, a lot of retail traders will jump in, right, expecting higher prices. So this is where all of the late longs are coming into the market, okay? And when you have late longs coming into the market, right, due to FOMO, fear of missing out, that's where the tops usually, take place. So that was three different technical areas, right? The fourth confirmation was very important, okay? So I've talked about this in the past. The fair value, okay? The S&P 500, or any stock for that matter, you could do this for Apple, Microsoft, anything. Calculating the fair value of these instruments, it requires pretty complex calculation, but it's public knowledge. You could find the fair value for these companies on the internet, right? I have a newsletter that I get. It's an institutional newsletter that my prop firm gets that just happens to have this number on it, and it comes out like once a week. But this is public information. You could find this on Google. You could find it on Twitter. It's out there. So the fair value on the S&P 500 on the day of the short setup was anywhere between 4,050 and 4,100. Okay, so anytime price gets up into that fair value region, it just gives the institutional participants a reason to take profit within that region or above. Because technically, if it's above what the fair value is, technically it's overvalued. And when an asset becomes overvalued, you want to take profit, right? So considering this zone and the 50% retracement were slightly above that 4,100 fair value number, it was just such an area of confluence that it was like a no-brainer short setup. Because also on top of that, the next day was FOMC. So now that you have price coming up into a supply zone and a 50% retracement where a lot of algos are tied to, and you had the fair valuation, right? Price was above what the fair value of the S&P 500 was. Going into a risk event the next day, it makes sense for institutional participants to take profit in front of that risk event for the next day if, the companies within the S&P 500 are slightly overvalued, okay? So this trade had many different reasonings behind it, and that is why I was so confident. The more confirmations you have, the more probability the trade is going to work, okay? So the more confirmations, the higher the probability. That is just, it goes hand in hand with one another, okay? So, like I said, those 4 different confirmations on top of the calculated risk, right? The original plan was 4.3 to 1 if it had played out all the way through. My final target was 3770, but I got stopped out of the remaining lots at 4,051 due to my stair-step approach. So the way my stair-step approach works is, let's just say I want to short an instrument at $1,000, okay? My stop loss is 1,100, right? I'm risking $100, and say my target is let's say 850. Okay, so I'm risking $100 to make 150. That's something that I wouldn't do, but for this example, let's just say that. So if my targets are 850 and then say 700, the moment my first target gets hit, which is 850, I move the stop loss from its original stop loss at 1,100 to the average entry price, okay? And what that does is, as the trade works out in my favor, I'm limiting the risk, right? I'm cutting the risk as the trade works out in my favor. So we're going to go over that right now for this particular setup. So I had my limit order set, like I said, days in advance. So the first limit order on the March contract, I said that I traded the March contract instead of the DEES because of liquidity, okay? I needed to make sure that there was enough volume just in case the trade went sour, right? When you have a news event, you have a price vacuum. That's what it's considered. People call it a price vacuum because algos are driving up the price hand over fist, and there's a lot of air pockets. They literally skip over points in the S&P 500 because it's just a risk-on algo driving the price up. So if you trade an instrument that has low volume, it can be very, very difficult to stop out during a news event, right? Where you have algos just, buying. So I used a market stop buy order as my stop loss. And what that does is the moment it gets triggered, it uses a market order to stop me out. So that's the reason I use the March contract instead of the DEES, because it had more volume on that particular week. So my first limit order was set to sell 10 lots at 41.35. My second was to sell 5 at 41.40. Then I had another one to sell 10 at 41.50, which was right in front of it was front running the 50% retracement at 41.55.25. Then I had another sell order to sell 5 more at 41.60, and then another seller order to sell 5 at 41.70. Okay, so like I said, my first limit order was set at 41.35, which was front running this supply. So what I'm doing is I'm averaging into the position based on the area that I'm working with, okay? And what that does is it gives me a better average price. Let's just say I sold the full position. It was 35 lots. Let's say I sold all 35 lots at 41.35. Now I'm risking, my stop loss was 41.86. I'll go over why. But now I'm risking 51 points on 35 lots. Okay, the way that I did it, because I averaged into it, I got my average sell price from 41.35, which was the initial sell, all the way up to 41.48.5. Okay, so I got myself a better average by 13.5 points, which helps tremendously because that also helps to limit risk more. So instead of just locking in all 35 contracts or lots, whatever you want to call it, at one price, I like to find an area to work with. In this case, it was the supply and the 50%, which happened to be inside of supply. So this supply zone was, let's see, this supply zone was, it was about 35, about 40 points, 38 to 40 points. So considering I'm working with a fairly wide area, right, 35 to 40 points, I don't want to limit myself to just one specific fixed limit order, okay? I want to be able to work around that area and average into the trade. So that's what I did. Many of you guys ask me what I look for when the trade triggers. I don't look for the tape. I don't look for any price action. I don't do any of that. I know Carmine likes doing that, and he's very good at that. For me, I just have these orders placed, right, well in advance, and when they hit, they hit. I'm not looking for the tape to speed up. I'm not looking for volume. I'm not looking for the VWAP to hit. I don't do any of that stuff. All I do is I preset all of my orders with calculated risk reward, and I just wait for them to hit. If they all get hit, great. If not, then I work with what I have. Okay, so in this example, they all hit. The stop loss was 41.86. Why? Why was the stop loss 41.86? I will show you guys right now. So in that video that I just showed you, one of the very common bearish and bullish traps occur when price breaks above or below important pivot highs and lows, okay? So the common retail trader way of thinking is, oh, I'll stop out above prior highs, or oh, I'm gonna get in on the breakout above prior highs. Okay, so what that does is it provides a lot of retail liquidity. Okay, and as a result, you'll chances are, historically speaking, you'll get a very aggressive trap that occurs because a lot of retail traders are looking to buy that breakout, right? Or they're looking to sell out of their short setups above the prior high. Because, like I said, a lot of the eyes of retail traders are on that prior high, and the institutional guys know that. They're using our retail liquidity for their own personal use, okay? So I'm going to show you guys. Let's see. I'll show you guys exactly why I picked that that stop loss. So my stop loss was 41.86. Okay. Why? Okay. I will show you right now. So the last prior high on September 13th was 41.75. Okay. So many retail traders who, were short, into that print were stopping out above the last macro high. A lot of eyes were on this high, okay? So, considering it was basically a area where a lot of stop losses went off, or a lot of retail traders were looking to get long above that high, okay? So there's a lot of liquidity above 41.75. That is why I wanted to give extra cushion above that, just so that I wasn't putting my stop loss in an area that is full of traps, okay? So the reason I picked 41.86 is it was just kind of like a 11-point cushion. If you guys remember, in the summer, I took a very similar short setup, and I got stopped out right before the drop happened, right? Because similar to this, I put my stop loss above a technical area, and right before the drop happened, price spiked up, stopped out a lot of people, including myself, up there, and then it ended up working. So, trading is far from perfect. So what you do is in times like that, it was very frustrating. I could have made a lot of money on that short. But instead of being frustrated, I learned from it. So that's why I used like an 11-point cushion above the last macro high, just in case this happened, and that's exactly what happened. So if I zoom in, you can see the moment price broke above the last macro high, retail got long and retail shorts stopped out, and that was a bullish trap. Okay. Now, could it have gone another 11 points and then reversed? Of course. However, you got to think about from the risk, reward standpoint. If I'm risking all the way up to 4,200, that's a lot of risk to put on. So, my average cost on the short setup was 4148.57. Let's just call it 4148 and a half. I sold 35 lots at that average, and I was risking 37 and a half points, right up to that 4186. So I was risking 37.5 points to make much more, right? So the original plan was 4.3 to 1 risk reward. I ended up getting stopped out of the remaining position at 4,051, which ended up being a 2.6 R multiple. So on the cover side, so now that I was in the short at 4148.57, now it was time to come up with an exit strategy. So I had my targets planned well in advance. Like I said, every single order was put into play before they were triggered. So the original orders are for the March contracts. Like I said, I put in these orders on December 11th. It was Sunday, that Sunday before the trade, right? The trade triggered on the Tuesday, which happened to be December 13th. I put these in 2 days prior, and I put in all of the short limit orders as well as the buy stop order. Once all of the limit orders triggered on the short side, then I went in and put the stop loss and the cover areas in. So what I mean by that, once I was in the full position, right? Once I had the 35 lots short at 4148.5, I then went ahead into my brokerage and I put different limit orders for the buy side to cover. Okay, so my cover points, my take profit points were 4,100, 4,051, 4,001. Then I had these ones never got hit because I stopped out prior. But then I had 39.51, 39.16, 38.60, 38.01, and then 37.70. So as I mentioned before, it hit 4,100. I covered 7. Then it hit 4,051. I covered another 7. Then it hit 4,001. I covered another 7. And because it hit my third target, I moved my stop loss down to the second target, right? That stair-step approach that I talked about. So when the 4,001 target got hit, my stop loss became 4,051. And then this was on Wednesday when Powell was talking during his press conference. Price spiked up, hit 4,051, and I sold out, or I should say I bought the remaining 14 as I stopped out because I had a buy stop order at 4,051. So, like I said, there were 4 main different confirmations, 3 from a technical standpoint and 1 from a fundamental using the fair value method. The Dow also had 690-minute supply that it also hit. Quite frankly, I didn't even see this. It was another member that pointed it out. So I didn't even use this in the analysis, but you could see the 690-minute supply up there, and then it hit it basically perfectly. So like I said, it's one thing if you have technicals, but if you lack the risk management and the ability to follow your plan, it means nothing. So that is why I like to automate my approach, and I like to pre-plan the limit orders and the stop losses well in advance, because at that point I could just sit on my hands and just stay waiting patiently, right? A lot of people think that you have to be good at reading the tape in order to succeed in trading. Don't get me wrong. I am well aware of how to read the tape. When I used to trade small caps, I was very, very good at reading the tape, as it was a major component of my system. However, when I got into trading options on large cap equities, it wasn't as easy to read the tape from my personal opinion. So I was still good at it, but I didn't have as much of an edge as opposed to the small cap stuff. So when I scalped, like I said, I was doing very, very well, but market conditions changed. And as a result, I started doing trades like these where I'm looking for the much bigger move. So the problem with the tape, in my opinion, is it's ever changing, okay? At 9:32 a.m. Eastern time, you could see massive bids coming into the market. The tape is looking healthy to the bull side, so on and so forth. And then 2 minutes later at 9:34 a.m. Eastern time, you'll see, massive selling. So I'm not a fan of how the tape changes in the blink of an eye. With my system, all of these contextual, areas of technical confluence are staying there. They're not moving. It's not like one moment they're bullish and then 1 minute they're, the next they're bearish. They're there. They are fixed areas that have high probability of working out. Okay? So that is why I prefer this system as opposed to the tape reading scalping. Okay? I get that question all the time. I could talk about it in another video if you guys want, but I'm going to cut this one here, and just look out for the one that I post on Wednesday or Thursday, where I talk about exactly how I calculate the risk reward behind every single one of my trades. Peace.